Good day, everyone. Bert Salazar here. Welcome to the Cambridge Financial Literacy Podcast. As a podcaster and certified financial education instructor, I strive to communicate and educate our clients, listeners, and followers in all areas of financial services and economic planning. In today's episode, we're going to be discussing the Volatility Buffer Concept. The Volatility Buffer Concept is one of the most creative retirement distribution techniques available in the retirement planning arena. And when properly addressed and executed, it provides a conduit and safeguard against asset volatility due to market and/or interest rate corrections during retirement. We had done a previous podcast that we called the rate of return dilemma. And there we were able to show all of you the difference between average rates of returns versus actual rates of returns and the impact that has on a portfolio over the long term. One of the things that we address with our clients and viewers and listeners all the time is that while you're trying to accumulate assets and you're working and you're employed and you're making contributions to your qualified or retirement plan or investment programs, you may not feel the pain when the market is making a correction and you have interest rate sensitivity along the way. And the reason for that is because you're still employed. You don't need any money coming out of those funds. Now, obviously, you do see the statements and you see the paper losses, but you don't realize the actual losses until you start taking distribution. Now, when you get to retirement age and you go from accumulation to distribution, the rules of engagement change completely. And there, you have to be very careful in what you do with your assets during distribution years where the market return has been negative in any way, shape, or form. So the volatility buffer concept is a distribution straddle technique, and a straddle is nothing more, nothing less than the combination of multiple products in order to attain a forecasted return and in order to maximize the efficiency and effectiveness of a portfolio over time. So the volatility buffer concept is a distribution straddle technique for clients wishing to preserve and enhance their retirement income while protecting existing assets from stock market erosion and sequencing of returns. Now, most financial planners and advisors fail to educate their clients on the impact of market volatility and sequencing of returns when dealing with longevity planning. Now, we specialize in retirement distribution planning at Cambridge, so we pay a tremendous amount of attention to this issue. As I stated earlier, the rules of engagement totally change when clients shift from accumulation of assets to distribution of assets. During accumulation years, it is about the accumulation rate, but during retirement years, it is about the distribution rate, and issues like taxation, inflation, asset volatility, and timing of market and interest rate losses can create havoc in traditional investment portfolios and retirement accounts. And that's an issue that we deal with on a daily basis. For this reason, we at Cambridge consider volatility buffer and distribution straddle techniques a critical part of retirement planning. No one can forecast a financial outcome. So being prepared is key to financial independence, for clients that may spend 20 to 30 years in retirement. In the following two samples that I'm going to be sharing with you today, we're going to see what happens when sequencing of returns on identical accounts, and you will also see and notice that option 1 and option 2 have the same amount of assets, the same amount of income distribution, the same amount of market returns, and the same 15-year period. Yet the outcome is completely different between the two options. So I'm going to give you two examples, in option 1 and option 2. I think you're going to find out that in option 2, life insurance is not used for death benefit purposes, but it is used as asset insurance in order to protect against market volatility and distribution from retirement accounts during negative years. So option one is a client that has assets, and we'll talk about that in a second, and he or she has no life insurance in place in order to create a retirement straddle. In option two, this client does have life insurance. Thus, you're going to be able to see a tremendous difference just because you have a retirement straddle technique in place. So with option one, the value of this client IRA, and we're going to be talking about IRAs or 401ks, so we're going to talk about qualified plan money. But in this situation, the client has $2 million at retirement, which is age 65. Now, do not be alarmed because the following concept will apply in every situation, regardless of the asset amount and or account value. So it could be $500,000, it could be $1 million, it could be $2 million, could be $5 million. The amount of the assets is really going to have no adverse consequence on the overall technique. Again, please remember that client insurability in the second scenario is very important, and the sooner that the technique is implemented, the quicker the volatility buffer accelerated growth, can position the client in an enviable retirement situation. Now remember the following. Retirement is about the distribution of assets and the ability to create distribution alternatives depending on interest rate and or market situational performance on an ongoing basis. So in option one, the client reaches the age of 65, could be a male, could be a female. He or she has $2 million in a portfolio, and it is necessary based on their standard of living. They want to maintain it accordingly throughout retirement. The client needs to pull out every single year $150,000 out of their account value, and obviously because it's qualified plan money, he or she is going to have to pay taxes on that distribution, and they're going to do that for a 15-year period. So we're going to go from age 65 to age 80. Now, by pulling $150,000 every single year out of their account, because they have no choice, they're no longer generating income. They've gone from people at work to assets at work. So now the assets is actually working for the client. So he or she is going to have to start taking that distribution regardless of market condition or where the returns are. If they have negative returns in 1 year, the client still needs to maintain their standard of living, so they're going to have to pull money out of that. And we notice by using a hypothetical market return, using the Standard & Poor's, the S&P 500, we notice that by the time this client reaches the age of 80, his portfolio and or account value has gone from $2 million down to $941,000 in change. Yes, the client has been pulling $150,000 a year, but no one knows how much longer this client is going to live. On top of that, I made it simple, so I'm just pulling out $150,000 on behalf of the client, and I'm not truly factoring for inflation because $150,000 today cannot buy you the same amount of goods and services that $150,000 will buy you in 15 years from now. Now, in scenario 2, or option 2, we have the same client, age 65, he or she, $2 million in a portfolio, but the client had created a distribution straddle technique where he or she bought a life insurance policy. In this situation, we're using whole life because it's guaranteed cash value, guaranteed interest rate. The only thing that is not guaranteed inside a whole life are the dividends. Even the death benefit is guaranteed. But again, the client is not using this whole life insurance policy necessarily as a death benefit vehicle, although it will be there if something were to happen in the future. But the client is using this primarily as a distribution technique. So in this situation, when the market drops from 1 year to the other, instead of the client compounding that problem and pulling money out of the traditional IRA or 401k account, the client is able to dip into their whole life and pull that money out. So you will notice that the ending account value between option 1 and option 2 are enormously different. In the situation that we're going to go through, you'll see that although the rates of returns and distribution amounts are the same, option 1 has an ending account value at age 80 of $941,000, whereby option 2 has an ending account value at age 80 of $3,793,000. Now you wonder and you say, well, how can that be possible? How can option 2 have 4 times the account value that option 1 has within the same time frame and by pulling out the same amount of money? Well, the answer is simple, yet it requires proper distribution planning. During negative years, the client is taking distribution out of his or her life insurance account, since asset growth inside a whole life insurance policy is guaranteed. Thus, client is allowing his or her IRA account to recover, from the previous year losses without having to compound the distribution problem. Now, once the IRA asset recovers during the positive years, client then commences to take money out and to start distribution of said account again. Now, moreover, a $150,000 IRA distribution in a 33% federal income tax bracket, and I'm using that bracket as an example, produces $100,000 of net income proceeds. A $100,000 distribution from a whole life insurance policy is the equivalent of $150,000 from an IRA, since no taxes are assessed due to cost basis and or loans. Now, please bear in mind, and we're going to cover these issues in future podcasts, but please bear in mind that there are only 4 vehicles in the IRS code that allow for tax-free distribution: municipal bonds, Roth IRAs, Roth 401ks, and life insurance. That's it, not anything else. Now, during ages 78 through 80, the client is required to take more money than the $150,000 because of the required minimum distributions that are forced upon us for all those of us that have qualified plans by the IRS. So at the end of the day, you have to bear in mind that retirement distribution and longevity living is predicated upon the right assets, producing the right amounts of income, distributing at the right time, protecting against the risk of living too long, protecting against the risk of living with a disability, and creating the proper volatility buffer straddle in order to mitigate dire consequences while safeguarding loved ones with incremental survivor benefits, because that's a major problem for especially husband and wives that are married and they want to live a long life in retirement, and many of them are going to live for 30 to 35 years in retirement. The golf clubs, and this is an analogy that I use all the time with clients, the golf clubs seldom win a tournament, if ever. It is always the swing and the management of the golf course that will guarantee success in the long term. Play the retirement game to win, and that's something that we try to strive with all our clients. Again, as an economic advisor, I assist my clients in changing the way they see things, because when they change the way they see things, the things they see change. Again, hope you enjoyed our educational podcast today. Stay tuned for our weekly Truth Be Told podcast through the Cambridge Financial Literacy Podcast channel. Should you wish to address some of the issues discussed here today, please feel free to contact us